Hello investors, and welcome to yet another edition of Smarter Money Matters with the Wealth Doctor, me, that's Jeff Camarda, and our super CFPs, Lou and Anna. Thank you so much for joining us today. And today's scintillatingly interesting topic is annuities, pros, cons, risks, and alternatives explained, or the truth about annuities and why we don't sell them and you probably don't want them. So annuities are wicked complicated vehicles, and we'll get into just a little bit of the complexity, talk about what is an annuity, explain what annuities are, the pros and cons of annuities, and we have a real nice AI summary here that Lou's prepared, using annuities for retirement. Should you buy an annuity? What's the difference between fixed and variable annuities? What's the difference between indexed annuities and variable and fixed annuities? And should you buy an indexed annuity? What about guaranteed income annuities, fees and commissions, which is a big one really, that's very difficult to spot. What the annuity surrender charges are, and which is really the flip side of the commission. That's why they exist for the most part. Some of the drawbacks, how the guarantees work, tax treatment of annuities, which in my mind is the most horrible of all the investments in the investment pantheon. Annuities have the worst tax treatment in a lot of ways. How fees affect annuity income and values, some of the fine print that you'll find in annuity contracts, some of the concerns about the alternatives to annuities, and there are quite a few, and in my view, most of them are superior to annuities, some of the pitfalls to avoid, and why we don't sell them. And I'd say this as a reformed top-producing annuity salesperson from back in my past in the 1990s. I was very, very active in this market, but as my education increased, and toward the end of my CFA, Chartered Financial Analyst studies, I just got to the point where I could not bring myself to sell them anymore, despite the high income that they produced, because it just didn't seem, it was a good deal for me. I don't think it was that good a deal for the clients. So why don't we begin, Lou? You've got some pros and cons, and we will churn through those. Before we do, it's really important for everybody to know an annuity is a life insurance contract. It is a life insurance contract. Burn that into your head. It's a life insurance contract. It can only be issued by a life insurance company. It's a life insurance contract. It's kind of the flip side of life insurance. It's it's how long will you live and how much money can we afford to pay you until you probably die. So it's the same, kind of the same math. But remember, it's got to be a life insurance contract, not a bank product. It's not a security traded on the exchange. Although sometimes they have securities in them, they're a life insurance contract. So that is, as a preface, tell me what some of the, we're going to play Stump the Chump. I'll be the chump, and you're going to tell me what you think the pros are, and I'll tell you if I agree with it or not.
Right. So a lot of people, when they're shopping for annuities and advisors, advisors that sell annuities are going to, list these items as pros to why annuities are a good product. So number one, it provides guaranteed income.
Yeah, and it is. It does. The essence of an annuity, and the way they were originally formed, it's basically you're buying a pension. I give the insurance company so much money, and they guarantee me a payment for life. And it could be the life of me and my wife, or there's a lot of ways to slice and dice the payment. But the simplest one is a pure life annuity that the payments go to me. So I get payments for life. Two of the things that there are pitfalls, or three actually. Number one, in the vast majority of cases, these are not indexed for inflation. So as costs go up, your income will not go up. And if you're getting $1,000 a month, the purchasing power may go to $900, $800, and so forth, because it's just like a mortgage, right? The lower the interest rate, and the interest rates are low now, the lower the payment, except you're on the bad end of the payment stream because it's not going to go up. Second thing is, if you die with a pure life annuity, what happens to the income?
It goes away. It
stops. So if I give the insurance company $1 million and I'm getting, what would that be? Probably $60,000, $65,000 a year, and then I get hit by a bus the next day, and Anna's my wife, she gets nothing, right? $1 million, so what did you do, you stupid son of a gun? That $1 million is gone. We only got $3,000 back. That's how they work.
Yeah.
And the other thing is the risk of the insurance company. If they go out of business, you're going to have a hard time chasing their money.
All right, so the next one that you'll hear a lot is they provide you with tax deferred growth.
And well, they kind of do, but I think in the worst possible way. So if you put money, you're talking about annuities that are not in IRAs, right?
Correct.
Because if it's in an IRA, you already have tax deferred growth, so that's kind of, maybe a slick sales approach.
Yeah.
But the thing that you can get tax deferred growth with growth stocks, can't you?
Sure.
Right? And or growth mutual funds. And is the tax rate better?
Yes, when it becomes time to take funds out, you're going to be taxed in a much more advantaged way with securities.
Yeah, you'd be paying capital gains rates or qualified dividends rate, so it's probably half. Annuities are taxed at your highest marginal rate, right? The highest ordinary income rate there is. And what happens if you take it out before 59.5?
There's an additional penalty on it.
10% penalty. So, and also, if Anna, invests in a mutual fund and she's got maybe $100,000 in it, it's grown to be $150,000, and she wants to take out $50,000, do you have to pay tax on the whole $50,000?
No, and it would only be gains on the portion of gain that I take out.
Exactly. What about an annuity?
Yeah, you have to pay 100%.
Because it's last in, first out tax treatment, so you're forced to pay tax on all the gains before you get back to your original investment tax free.
Yeah, absolutely.
Right? So with the tax rate, there are a couple other things. Not only do you pay the highest marginal rate, it's taxed on a LIFO or last in, first out basis. What about when I die, Lou? When poor old Dr. Jeff passes on, do you get and you're my son, boy, you sure have grown. You get a step up in basis?
No, you don't.
No.
Yeah.
Unlike virtually every other investment that's out there, the gain is not forgiven at death with annuities. It is with virtually other investment.
Yeah.
So it's got. And before get back to the first point, sometimes I'm not saying annuities are evil, but they become so convoluted and the commissions are so outrageous in many cases that it really drives sales that I don't think should occur. That folks are being told to buy annuities for reasons that really aren't a good fit for them. But it does provide lifetime income. If you need a pension, that's what the basis of pensions are. They have a place, but I don't think I think they're frequently misplaced. What's the third one?
Well, third one is downside protection, or protection from market downturns.
And it depends on the annuity, right? So if I buy a fixed annuity, what am I investing in? Anna?
Essentially a bond, similar to a bond.
Yeah, it's kind of like you basically, insurance company, remember, the insurance company's promise, it's not a bond, it's not a bank product, insurance company's promise is basically to pay you fixed interest. But it's kind of similar to a CD. It's like you'll get a fixed rate of interest at 3, 4, 5%, right? Mm-hmm. So in a fixed annuity, the downside is guaranteed, at least ostensibly. But what about a variable annuity?
You're investing it into a fund. Right?
So you're basically got mutual funds, right? That you're buying inside of a life insurance wrapper, which increases the complexity, really screws up the tax treatment, and increases the cost dramatically. But do I have downside protection there? Could lose all my money, right? Sure I could. I mean, it's probably death benefit, but it's it's a very thin veneer of what people will think about downside protection. And then equity index annuities, which we'll talk about in a little bit, do have guaranteed floors, but you got to read the fine print. These are such complicated contracts. I've seen them where the guarantee was 85% of your initial investment. It's guaranteed. It's guaranteed a loss of 15%. Yeah. But the agent's not saying that. He says, it's guaranteed to get your money back. Well, you better read the fine print, and it's about that much fine print you got to go through from very smart lawyers that put this together. What's number 6?
So number 4, actually, it's
sorry,
jumping ahead.
I'm getting hungry.
Yeah, but the advisors that sell annuities are going to want to they're going to make you believe that they're customizable, so you can add different riders onto them.
Yeah, but so basically when you say they're customizable, that means you can buy different insurance features at additional cost. Sometimes that makes sense, sometimes it doesn't, but it can ratchet the cost up. I've seen them as high as 5-6% in hidden fees. Yeah. Right? But is this obvious to the client? Typically not. You got to dig down. You have somebody that knows where to look. A lot of folks don't, including those, a lot of advisors. You got to know where to look to find out what the actual costs are. You have mortality charges, you have mutual fund charges, you have premium taxes, you have contract costs, you have rider expenses. I've seen them like 6% a year. Outrageous.
Yeah, it's a lot.
Yeah.
So the next one, and we see these a lot. I'm sure, Anna, you've seen these a lot too. They'll say there's no contribution limits. Just like on an IRA or 401ks, there's contribution limits. But then we'll see annuities in IRAs, and not so much 401ks, but that's definitely.
Well, all I can say, Lou, is AI schmai. Okay, is your contribution limit if you open an account? It's Charles Schwab, you can put as much in you want, right?
No. Yeah.
The only difference is you probably get better tax treatment.
True.
Any other pros?
That's all the pros that AI spit out. That is.
Any cons that you have?
Yeah, I mean, the first one that we've already kind of touched on is the fees and the expenses of the annuity. High annual fees, and then rider costs, different things that a lot of times are hidden, that can really impact the performance of the annuity.
And these can be wicked expensive, but one of the nice things about variable annuities, not nice, but one of the more transparent things about variable annuities is you can look up the fees and expenses. If you know where to look, is the mortality cost of life insurance charges. You really should pay in life insurance often 1%. You invest $100,000 today, and your death benefit is $100,000, and you pay $1,000 a year for that privilege of just getting your freaking money back. Crazy, but it really is. It's just outrageous. But at least you can look them up. With fixed annuities, which include indexed annuities, it's really, they don't tell you. They just tell you what the interest rate is going to be. And with an equity index annuity, where the S&P goes up, you get there's participation. It looks like in the investment markets, but you don't know what you're paying for that.
Yeah, the next one was the fact that a lot of these annuities are not liquid and they have surrender charges.
So let's talk about, there's really two aspects of that, right? The first one is the liquidity problem. Most of them you can cash out and get something. The question is, do you get, a fair amount back? And frequently the surrender charge is the biggest factor on how much you get back. So, what is the surrender charge, Lou and Anna?
I mean, essentially it's the commission that was paid to the salesperson spread over X amount of time, that if you cash out that annuity early, you have to pay that surrender charge out of your initial investment or the investment you receive back.
Yeah, and actually that's a pretty good, distillation of what it is, though it's kind of hard for the consumer to see that because there's so much complexity. And if you look at an annuity statement, you'll see account value, accumulation value, surrender value. Sometimes you will, sometimes you won't. So it's kind of hard to focus on, and human beings will typically focus on a bigger number. So if I put $1 million in an annuity and the surrender value is $900,000, but I see an account value of $1.2 million, how much do I think I have?
1.2.
Yeah, it's pretty misleading, I think, without really understanding what's happened. But to your point about the commission, the surrender charge largely exists to protect the insurance company if they don't have the money long enough to make up the sales commission they sold. So a good way to look at that is an example that we used in a previous podcast, I think, is we have Sally that bought that annuity from the broker for $1 million, and when you look at the surrender value, it's $900,000, right? So what happened was the broker, in this case, probably made a 10% commission. $1 million goes in, they write a check the next week, back when I was selling them, is $100,000, pretty good pay for taking Sally to lunch, huh? And there's $900,000 left. So if the insurance company paid me $100, and Sally put in $1 million, but $100 went to me, and Sally wants her money back, how much money's left?
900.
It cannot be otherwise, right? So the surrender charge is designed to protect them until they've made enough money back by maybe earning 10% on Sally's money to simplify this, and giving her 7, making 3% a year after their costs in order to actually have the annuity be profitable. Does that make sense?
Yeah, makes sense.
And a lot of time these stretch out for years. I've seen them as long as 15 or 20 years which is just outrageous. You know that I think that they call it the Federation of Insurance Commissions, whatever. There's kind of a quasi-regulator of life insurance companies, and their best practices now, to protect the best interest of clients, and this is just in the continuing education they did last week. You know what the preferred maximum surrender charge and surrender period is? Bet you can't guess. Try to guess.
10 years and close.
Yeah. Surrender charge?
10%.
10%, the 10-10 rule. You're only losing 10% of your money, only got to wait 10 years to get it back. Does that seem like it's in the consumer's best interest? I don't think so. You got to be really, really careful to figure this stuff out, though, because it's buried in pounds of disclosure that it's so burdensome, they hope you don't read it, and almost nobody does, except for guys like us. What's the next one?
We've hit on this a lot, but complexity with the product structures, the riders, payout options. Again, we've hit on that, but they're extremely complex.
Yeah, but it's so hard for consumers to understand. I'm telling you, a lot of the agents don't seem to understand it. They know what their commission is and when they get paid. But let's take a look from some of the parameters that you're going to find in index annuities. And one is the participation rate. The participation rate is the percentage, so that if the gross return is 10%, and you participate to 70%, how much do you get?
7%.
7%. So they take a shaving off the top. So the participation rate is really important, and it means you don't get all the return. The insurance company keeps some, therefore, they're not a charity after all. Another way to look at that, and sometimes it's in addition to the participation rate, is a spread. Like they'll take the first 2%. Another thing to be concerned are cap rates. Any of you guys know what a cap rate is?
Yeah, so if the market, let's say, the annuity is tracking for example, S&P 500, and S&P does 10% this year, but your cap is only 7. You only get 7 of that 10%.
Yeah, so and you can have a cap rate and a participation rate typically are both elements of a complicated equity index annuity contract. So you can participate at 7% and be capped out at 12.
Right.
So if the market goes up 40%, your participation rate is 7. The most you could make is 28%. Gee whiz, they're making what, 12% on top of that? But you got a cap at 12%, so they keep all the difference. It's really most people don't really appreciate this. Another thing I like to touch on, we have some more disadvantages, right?
Yes.
Is market value adjustments, which is another wicked, sneaky way that insurance companies, and you see these in all sorts of annuities, are able to transfer more risk of this guaranteed product from the insurance company to the insured. So remember, all but variable annuities, all fixed annuities, of which index annuities are a subset, basically take the money and they buy a bond or some other, very safe product that they're allowed to invest their reserves in by the various state insurance commissioners. Okay, so what happens to the value of bonds when interest rates go up, guys?
Goes down.
The value of the bond goes down, right? If there's an MBA in that contract, a market value adjustment, who do you think eats the loss on the bond? The insurance company or the owner of the annuity?
The owner.
And that's what an MBA is. And they're all, I tell you what, it's usually on page 64, with 3 pages of how the lawyers figured how it would be calculated. But market value adjustments are another, really dangerous pitfall. All right, so what else you got? I could go on obviously all day, but what else you got?
Yeah, we hit on this a little bit, but the taxation. So in a taxable type, annuity, the gains are taxed as ordinary income. And
you're taxed first, last in, first out, and you don't get any capital gains treatment as you mentioned, and there's no step up in basis of death, just really horrible tax treatment. The worst of any investment product I'm familiar with. What else you got?
Last one is insurance company credit risk.
Okay, and that's just one of Lou's favorite, the concerns about annuities. Tell us about that, Lou.
Yeah, so that basically means that if you give your money to an insurance company and they go bankrupt or they go out of business, you're basically left with nothing.
Yeah, with a thin shot at getting it back from state, guarantee funds, and that's a really, really important consideration. And we'll finish on this because I know we're getting kind of long in the podcast tooth here. is that, insurance companies, when they say it's guaranteed by the insurance company. It's not guaranteed by FDIC or Securities Investor Protecting Corporation or a lot of other government backstops. It's the life insurance company contract, and it's there how well they manage your book of business and their reserves. And if they go belly up, and it happens occasionally. I remember in the early 90s, they were dropping like flies. Some people had to wait decades to get their money back. California, I think. But it's so important. This is a long-term promise. As I was talking to my son and his soon-to-be wife earlier about buying life insurance, the insurance company's ratings are so important because it's important they be there when you need your money back or the death benefit to get your annuity back. Absolutely. And there's a lot of really shaky ones, and a lot of consumers and agents, unfortunately, they look at the numbers, but they don't do the underlying due diligence to make sure they're investing in a safe product. You buy a CD at a bank, as long as you're giving the FDIC limits, you're getting your money back. Not so fast with annuities. You guys have any concluding remarks? We could go on. There's going to be a lot more upcoming podcast episodes on this because it's such a complicated vehicle, and it's just so popular, and there's so much of it that's sold, and so many of you have billions and billions of dollars that are invested in annuities. I think you need to understand it better. But do you have any concluding comments?
For me, clients you're going to come across advisors and agents that sell these products, and obviously to them, as Jeff, as we pointed out earlier, it's very lucrative for them to be in this business. But it may not be as beneficial for the client to buy these products. So do your due diligence, do your research, talk to fiduciary financial advisors, and really see if this is something that you want to go into, or something you want to buy before you actually put your money in.
And you understand what it's costing you, because you don't rely on the agent. There's a whole bunch of required disclosures that the new rules require, and I bet that there's a lot of agents that aren't going through that, because if you really understood, you was Mr. Investor, just so you get it straight here, put $1 million in this annuity, great annuity, right? But if you want your money back next year because you can get a CD for a higher interest rate, you only get $880,000 back. Sounds good, doesn't it? Who would buy that? But that's the reality. But if I'm going to sell that to you, I really can't be quite that honest about it. Do you have any final remarks?
I mean, I'll just agree with Lou and everything we've talked about.
We always agree with Lou.
Yeah, of course. But they're
So she says. So she doesn't.
I mean, they're complicated products. Work with experts that don't have an interest in you purchasing the product, right? And just make sure it's right for your situation. And it's, again, if this is a legitimate product that makes sense for you, taking time to do due diligence shouldn't make a difference.
Understand the cost, and the commissions are met. I hear a lot of people, I'm not paying commissions so long as I'm making money. Yeah, but remember, it comes out of your pocket. If you put in $1 million and you shave down to 900 grand, you're only starting with 900,000. You got a long way just to break even. And then I'll finish with this. We get a lot of new clients that have annuities, unfortunately, from past advisory relationships, and develop what we call annuity rescue plans. And sometimes, because of the tax characteristics, they need to stay in an annuity, doing what's called a 1035, Internal Revenue Code Section 1035 exchange. Basically, it's a tax-deferred exchange, like an IRA rollover. All right? But there are a lot of cheap annuity and life insurance products that have developed, so-called no-load products, that are much cheaper and more consumer favorable. I still hate the tax treatment, but sometimes you're stuck. But at least you'd have the opportunity with fairly priced products that aren't loaded up on commissions to get a better return than you would, with some of the things we've been discussing. So thank you so much for watching yet another episode of Smarter Money Matters with Lou and Anna and your wealth doctor, Jeff Camarda. Till next time, thanks for watching.